something which the stock markets behave, that politics is a very important plank in determining stock market returns. Actually, the data suggests otherwise, because what is the market's biggest fear? The market's biggest fear is that we will not have a majority-led stable government at the center. Coalition governments are bad, they lead to instability, poor economic policies, and therefore poor stock market returns. However, if you analyze the history of the last 10 odd years, 10-15 years, and look at successive governments, it is easy to see that the UPA 1, which was a very poor coalition government in terms of the strength of the government, where the Congress with fairly limited number of seats led a government for 5 years. Economic returns, earnings growth and stock market returns were the best in the last 15 years. You look at UPA 2, which we all admit was a poor government, there too another coalition government, and not a good one at that, but the Nifty doubled in that period. What has been the experience for the last 4 years of a majority stable government? The Nifty has gone up 50% or thereabouts. So this myth that majority governments automatically lead to stable return or superior returns from the stock market or superior economic and earnings performance is actually not borne out by hard facts, and therefore investors should actually not make that inference that politics and stock market returns actually follow one another. There have been enough instances in the past where the market has got the reaction to a political outcome wrong. There have been instances when a particular party has come to power and the stock market has gone up or down 10% on the day. Eventually, on hindsight, that was a wrong move to have taken, because the economic management and returns actually turned out to be very, very different from that first day reaction. I think it's fair to say that the market is not always right in assessing political outcomes. What investors should do is actually take the call that political parties don't actually matter so much, and therefore use any major volatility to move the other way and to capitalize on it. If stock markets plunge because of a political outcome and all other factors are equal, it might actually on hindsight turn out to be an opportunity, and the opposite is also true. So my submission is that don't read too much into political outcomes in deciphering or tailoring your earnings expectations or stock market return expectations, because data tells us that that could be fallacious, and you should actually probably be better off using this volatility to your advantage. They don't. Political outcomes actually don't matter so much to the fundamentals of stock prices and therefore to stock market returns. The current government is a good example, because when the Narendra Modi government was sworn into power, the two sectors which actually did very well were PSU stocks and defense stocks, because of the market's belief that a strong majority government will actually galvanize the PSU companies and lead to superior returns, and that a strong muscular government will lead to great strides in the defense space, and therefore defense is the space which will lead to superior returns. 4 years out, we now know how that turned out. PSU stocks as a basket have been the worst wealth destroyers, and people have made no money from those defense companies which they thought so highly of. And that tells you that all these notions of political outcomes actually mattering to the fundamentals of individual stocks is vastly exaggerated. Actually, the thing that people should believe is that most political parties are akin to each other as far as economic management is concerned. The market may feel otherwise, but in India, whether it's the BJP or the Congress, they are actually variants of each other. They more or less have the same economic policies, and therefore for the market to conclude that one party is vastly superior to the other, whichever way, is actually a misleading thought and best abandoned.